Well, good morning, everybody, and welcome to the March edition of our Economy and Investments webinar. My name's David Baker. I'm Chief Investment Officer here at Mazars, and I'm joined, as ever, from Athens by our Chief Economist, George Ligarias. So you're very welcome this morning. If you have any questions as we go, we'll try and leave 5 or 10 minutes at the end to try and pick those up. So if you do have those, please do pop those in the Q&A as opposed to the chat, and we'll do our best to answer as many as possible. So without further ado, let's kick off and have a look at how markets have been year to date. And it's not a terribly pretty picture, albeit just at first glance, it looks as though everything's been more or less, hovering around zero. But of course, the scale on this chart is completely influenced by what's happened in the commodities market and in particular in the oil market. So you can see the big bar there for Brent showing that oil year to date up around 60%. So almost just by virtue of that scale, everything else looks inconsequential. It's not. Gold, where we've got an overweight position, has done very well year to date, up over 7%, and indeed all commodities essentially, not least through the war in Ukraine, have seen price rises. From a more traditional assets perspective, equities have sold off. So globally, because they're dominated by the US, have sold off. But the one area, and again, we had an overweight here going into this year. The one area that's done reasonably well, or relatively well, is the UK, which is posting a positive. Now, of course, the UK does have more than its fair share of energy and oil and gas stocks, which is the primary reason why that has done relatively well. Elsewhere, there's clearly a geographical tilt based upon proximity to the problems in Ukraine. You can see that Europe is now way below the US, which had started the year as being the market not in favor as the sort of excesses blew off the top of the tech sector as we started the year. So equities, reasonably miserable, and then bonds, perhaps even more so. So you can see gilts there, the very safe part of your portfolio, losing nearly 8% year to date as interest rates go up, depressing bond values. And I guess the only other thing to say is you've seen a resurgence of the dollar as a sort of safe haven currency, and particularly against the yen. Normally the yen operates in the same way, but not this time around. So the dollar appreciating significantly against the pound and indeed the yen, and certainly against the euro. So not a pretty picture to start the year. Why has that been? Well, obviously we've got the war in Ukraine, which brings about a huge amount of economic uncertainty on top of all the humanitarian difficulties that those poor people are facing. But principally how that's translated economically, if we go to the next slide, is through inflation. And you can see there, UK inflation rising at the fastest rate for over 40 years. So the absolute level of inflation not nearly as high as we were back in the 1970s or indeed the back end of the 80s, but nonetheless the rate of inflation has been significant, and the landscape for where that inflation is being driven from, and therefore what we think about it, has changed quite significantly. So we were talking about inflation pretty much all of last year, but inflation brought about by the pandemic, lockdowns, disruptions to supply chains. And therefore there was this feeling that there would be a transitory nature to this inflation. Supply chains would mend themselves and we'd go back to where we were previously. We talked about the possibility of that temporary inflation developing some psychological aspects within the labour market and perhaps becoming more permanent. But all that now has been replaced by the fact that we have the war in Ukraine, and that is having a very clear and obvious impact on commodity prices, not least wheat, sunflower oil, and of course oil. And then when you start to dig further into the sorts of things that Russia and indeed the Ukraine exports, you find more and more about how dependent we are in an awful lot of manufacturing processes on those raw materials. So going from a position where markets weren't quite sure whether inflation was going to be transitory or not, to one where we're really starting to think that inflation might be here for a period of time. And of course, given the nature of the conflict, nobody really knows how it's going to resolve, or indeed when it's going to resolve, and therefore a significant lack of visibility on those inflationary forces. So what does that mean in the markets? If we go to the next slide, you can see what that's done to bonds. So here we are showing the UK 10-year Treasury and the US 10-year bond as well. And you can see that since the start of last year, a very clear upwards trend. So in the US, if you were lending to the US government for 10 years, about 15 months ago, you were being paid less than 1%. You're now getting paid about 2.5%, which is a level that we've not seen for quite some time. And a similar trend within the UK. And George and I have been speaking about this for the last year or so, about what level of US 10-year bond yield do we think is going to be attractive to markets? And perhaps only a few months ago, we'd have thought that 2.5%, maybe 3% was a point at which people would be attracted back into bonds, representing a decent investment opportunity. Of course, the thing that that has changed, that we just talked about, is inflation is that much higher. So although you're getting a higher return on bonds, in real terms, having taken off inflation, you're still effectively locking into a negative real return. Nonetheless, 2.5% we think might be a number that will attract some money into that market, but we don't know where interest rates are going. Certainly, the US Federal Reserve is talking much more hawkishly about interest rate rises as it tries to combat inflation. I'm sure George will have something to say about how successful it may or may not be. So bond yields rising, and then of course that means that the price of those bonds falls and affects portfolios. So that's bonds. Equities we've already touched on, but let's look at let's go a level deeper and start looking at some sectors, and that graph is really quite stark. I mean, the title says only energy is positive. Actually, materials have been marginally positive, but you get the idea. Pretty much everything has been suffering year to date, with the sole exception of energy, for obvious reasons. So the things that did very, very well in 2020 and 2021, those growth stocks, and in particular tech, they've sold off significantly. And what support there is in markets is really just reflecting the scarcity of certain commodities and the price rises associated with those. So where does that leave us in terms of equity valuations? Next slide just shows, if you've been on these webinars before, you might well recognize this. We talk about something called the price to earnings ratio. So put very simply, how expensive stocks are compared to their long-term average. And by expensive, we mean how much you pay for it for each dollar or pound or euro of earnings that company has. And we've talked in the past about concerns of how inflated these levels looked, and particularly in the US and particularly in certain sectors, you were talking at price to equity ratios of 40, 50, which gave the whole of the US market PE ratios of about 25, 26, which were way above their long-term average. You can see now that we've come back quite a lot from that, and the US trading under 20, and indeed the world trading under 18. World and US still expensive compared to their long-term average, as you can see on the right-hand side. But whereas the UK was the only region sitting below the axis, looking at a discount against its long-term average, we can now see that there are other geographies in the same boat. So a fair amount of sort of rationalization, getting us to what you might argue is a more sensible place in terms of equity market valuations. That's not to suggest that we've got there in a sensible fashion, and as I'll talk about in a moment, markets really directionless and not clear where they are going. But nonetheless, where we've had concerns in the past about perhaps overvalued equity markets, some of that bubbliness perhaps having blown off. So that's where we are now, but I mentioned we're directionless, we're trendless. Next slide just talks about volatility, so the extent to which markets go up and down within a day or within a week or with whatever time period we're looking at. This particular chart shows US equities and their high-low difference on a daily basis. So just how much swing there is within one market session. And if you watch the markets closely, you can see this quite obviously. Less at the moment, but certainly 2 or 3 weeks ago, you were seeing markets up in the morning, down in the afternoon, and then back to where they'd started by the close of the session. And this is just indicative of the difficulties that markets face right now. So you can see if we extrapolate the volatility we've had so far in 2022 for the whole of the year, actually we get the most volatile equity market that we've had for a decade. Not as volatile as it was around the end of the last millennium when you had the tech bubble burst, not as volatile as we had during the financial crisis 07-08, but nonetheless more volatile now than 2020 when we had COVID. And I think it's probably important to say that if you think about the COVID, the pandemic period and the response in 2020, and indeed the response to the global financial crisis, the one thing that you had in response was a very accommodative monetary policy. So very low interest rates and a significant amount of money being put into the system through the mechanisms of quantitative easings in its various forms. So that volatility associated with significant support, whereas now we're considering volatility in markets with an expectation of a quite significant reduction of support from central banks at least. So we do expect interest rates to go up, and we do expect not only will quantitative easing be stopped, but actually you'll move into a period of quantitative tightening. So this is really what is exercising markets and why this volatility is particularly concerning. So let's go to the next slide, please, Harry, and you'll see just to continue that theme, there is little in the way of identifiable trends within markets beyond that favourance for equities which are associated with the oil price or in the energy sector generally. And you can see, the left-hand side chart on the right hand side of that bit where the little arrow is, you can see that there has been no difference really between growth and value. So growth stocks, which had been very much in favor throughout the pandemic period, throughout the lockdown period really I ought to say, where the technology stocks and those companies with very high expectations of growth in the future were very much in favor. That's now broadly ceased, and you've got parity between growth stocks and value stocks, even though value was in favor at the very early part of the year. Pretty much everything's gone back to that central line where there's no preference within the market for one over the other. And then the right-hand side chart, same sort of story. At the right-hand edge of that chart, which is year to date, again, no real preference for large cap over small cap. Everything bar those commodities and those commodity-linked equities being treated in the same vein. So markets really not sure what they're doing, but they know they're nervous, and this is very obvious from the amount of volatility in markets. One more slide perhaps on that. If we go and look at why that is, and I've already alluded to this, rate expectations in the US and indeed in the UK, and more recently, talk in Europe as well of interest rate rises. And you can see there a very clear correlation between changes in expectations for interest rates and the volatility in markets. So the light blue line being where we expect, or where the market expects rates to be in February of next year, and how that's developed over the last 3 or 4 months, gone up quite significantly, and what the volatility has been in US equities. So, why do we put this in there? Well, it's just to re-emphasize that point about accommodative monetary policy really being absent. And we do think that we are at a very significant point in the recent history of markets, this move away from quantitative easing and move away from very loose monetary policy. We've talked about this many times. When interest rates are rock bottom, it really gives investment managers and retail investors troubles in terms of trying to find value. If you're getting paid very little on the safe stuff, i.e. cash, US treasuries, UK gilts, or indeed corporate bonds, if the yield is so low, then you're automatically pushed towards things of higher risk, and hence why we've seen equity markets do so well over the last couple of years. Despite all the doom and gloom of this year and how equity markets have reacted, let's not forget we've had 2 really bumper years of probably undeserved returns in equity markets, and it's simply a function of the supply of money into the financial system and that having to go somewhere, and the somewhere not being cash and not being bonds, and therefore it becomes equities. So when you start to remove that, both in terms of money supply through quantitative easing and also through interest rates going up, it starts to bring about that nervousness in equity markets, and hence that very clear correlation between stock market volatility and rate expectations. So final slide from me, and then I'll pass to George just to sum up, and I'm sorry to be so gloomy, but what we're seeing here is 2022 is very much a poor start to the year for investors. So here we're looking at a 50% equity and 50% bond portfolio the first 3 months of the year, and you can see that's the 3rd worst year in recent times. Not as bad as 2020, not as bad as 2009, but nonetheless, pretty unimpressive. It ought to be said, 2020 and 2009, the 2 worst years on that chart, were fantastic years for equity investors. So in 2020, despite COVID and despite lockdowns, MSCI World returned 13%, and in 2009, coming out of the financial crisis, returned over 20%. So just because you get a bad start to the year doesn't necessarily mean that's reason to disinvest and go and hide money under the mattress. You can have an extremely good year even if you have a bad start. However, as we said, the environment in 2022 is probably significantly different from those 2 years, so I'm certainly not drawing direct parallels there. So that's how we've started the year, sort of first 3 months or so, and I'll pass to George to try and make some sense of where we go from here.
Thanks, David. So what is it that's so different this year than previous years? And the answer is inflation. We had a lot of inflation before Ukraine, and that was due to supply chain issues. But supply chain problems, they were sort of mending. In January, February, we're seeing data which suggested that things were improving at a faster pace than what we had already predicted. So things were going good. And in some European countries like France or Germany, we even saw headline inflation fall. Okay, and this suggested that we could see that trend followed in the US and the UK. But that didn't happen because in late February, Mr. Putin decided to invade Ukraine. Both Russia and Ukraine are key producers of uh, goods, raw materials, food, and that really had a huge energy, and that really had a huge impact on prices. Everything is up 100 to 200%. Oil is up 100%. European gas is up in 230%. Wheat, nickel, steel, and aluminum, they're all up nearly 100%, and a little bit less for palladium and copper, only 50%. This affects the vast majority of goods and services. Okay, you need nickel to create batteries for cars. You need palladium to create the engines. You need steel and aluminum to create the frame. So 6 months ago, it was just not having enough microchips. Now it's not having enough of anything. And energy prices, it doesn't take an economist to tell you that they're going to feed throughout all the prices for products, because people have to keep their shops running, and they're going to incur higher overhead costs. More so because as we try to defossilize society, so we don't do coal anymore, we're doing less oil and more European gas, but more gas. Europeans especially have designated gas as green investment. Then obviously now we're more dependent on gas, which is actually Russia's main export. So the point here is that after Ukraine, this inflation went into overdrive. Instead of mending, it went to overdrive. But it's not just Ukraine. Next slide. What we're seeing is that China is not the usual deflationary force. So what happened first of all is that China used to drive deflation down. When my daughter was a kid, I bought her. I spent 150 quid and I bought her a little electric vehicle. When I was a kid, those gifts were way beyond my father's pocket. Okay, they would cost almost a salary, and now it's you can get it for 99 pounds. And that's China for you. It brought deflation. It brought a lot of cheap products, but China does not want to be the world's manufacturer anymore. It has turned inwards. And that is already causing prices to rise over the longer term. And of course, because China is in the thick of it when it comes to using all those raw materials, producer prices, they're very high. And on top of everything, they're facing fresh lockdowns. Remember, their approach was not to take in COVID and mRNA vaccines like we did. They manufactured their own vaccine and they shut their country essentially. And now that this O2, Omicron 2, whatever the new variant is spreading at a very fast pace. All it needed to do was just break through that shield, and now it's in the general populace. Shanghai is closed, Hong Kong is closed, and we're not really sure what happens next. So we're facing fresh lockdowns in China. And why is this important? Because China is still pretty much the world's manufacturer. It's trying to change that, but for the moment, it is. The next slide, please. And the third reason why inflation is so high is that the labor market is very tight. So a lot of people did not return to work. That means what we call the labor participation rate. People can work, but they, for whatever reason, they choose not to. And less people in the workforce means that companies have to compete with each other for talent, which means that they have to raise wages, and that really scares central banks. Now, next slide. And one thing about this inflation, and I'm sure I made the point before, but I want to emphasize it. It's way more broad-based than what we saw a year ago. A year ago, it was really supply chains and microchips and goods that were close to the end of being manufactured. But now we're seeing it in raw materials, and raw materials feed into everything. The price of wheat goes up, that means the price of corn goes up. The price of corn goes up, it means that livestock, it will take a lot more money to feed the livestock. That means the price of meat and poultry go up, and so on and so forth. The more in the bottom of the value chain something lies, the more value chains it's going to affect. So this is going to be the high inflation of pretty much everything. Okay, and this is causing a huge pressure on the economy, because the average consumer, if they see a loaf of bread costing 50% more, as I saw this morning in my own bakery, then they probably will defer big spending decisions. They will not go buy the new car, they will not move house, they will not spend money on the economy. And whereas it makes little sense to hold money in the bank, maybe sometimes you think, okay, in the bank I'm losing 10%, making big decisions cost me 50% more, and I'm not sure I want that. Or people are just afraid. When people are afraid, that's what they do. They keep money aside so they don't spend, and that constricts consumption. Now, on top of that, next slide, please, we also have monetary policy. And this is a humble opinion here, but I think it's going the wrong way. So the playbook from the 70s says that when inflation is rising, we must hike interest rates to curb it. And that worked in the 70s, but the 70s were all about introducing fiat currencies. Okay, we stopped the gold standard and we're now into little pieces of paper that mean something. And that was very inflationary. So putting up interest rates was probably part of the right remedy. However, this is just supply inflation. So putting up people's mortgages and doing it in an aggressive way until the end of the year might not necessarily be the best policy going forward. Even central bankers argue amongst them over that. The Europeans adopt a more easy stance on rates. The Americans and the Brits want to tackle the problem head on. However, the impact of those rate hikes on inflation may well be minimal. That was, in fact, commented on during the recent budget, where the chancellor said we do expect inflation to rise, and there's pretty much nothing we can do about it. How can they stop prices rising when virtually everything we produce, there is a part of it that does come from abroad, whether it is the raw material or an unfinished product or what have you. Okay, you might very well have livestock raised in Edinburgh, but if all prices for corn go up, even if that corn is produced locally, well, somebody will opt to sell it abroad at a lower, at a higher price, rather than use it internally at a lower price. This is a globalized economy. You can't seal yourself from it. Now, next slide. As I said, hiking rates too fast has led to recessions. Okay, especially in the US, but also the world followed. And the extra issue here is that in the past, especially 1981, in the early 90s, and in the early 90s, what the clever thing that governments did was, on the one hand, they raised interest rates, the cost of money, to fight that particular inflation. And on the other, they let banks, they deregulated banks to lend out more. Okay, by the beginning of 2000, banks were completely deregulated, which in fact led to the global financial crisis 7 years after. But now we are reaching the one stage in the last 50 years where we're going to be aggressively hiking interest rates and not deregulating banks at the same time. And this creates for a very explosive cocktail for growth. Okay, why do we ideally we want banks to lend out more money? Because by creating credit, you create money, you let money flow into the economy, and people can yes, on the one hand, obviously that might be a little bit inflationary, but on the other hand, it keeps growth going. The way we're going to do it is probably going to be more depressive for growth. In fact, we're now at a stage where growth and inflation are competing targets, and this creating huge problems for policymakers. Next slide, please. Already the economists were watching at in Bloomberg are already revising growth down, both for 22 and 2023. Already growth for this year has been revised down almost 1% to 4%, and 0.2% for next year to 2%. I think these numbers may well go down more in the next few months, especially with this very poor outlook for growth. Next slide. So what do we have? We have low growth and high inflation. Next slide, please, Harry. And this is what we know as stagflation. People who've been with us before know that they have seen this chart before. We've been talking about it for a year and a half. And now stagflation is becoming a reality. It's a very, very poor condition because the stagflation eventually also leads to higher unemployment rates. Okay, so this is from an economic perspective, this is not a great environment. And in fact, we would expect this economy to continue like this for possibly a little bit more than a year. Next slide. On top of all of that, we can't make the mistake again to assume that, hey, global supply chains are going to remain where they were and they're just going to keep supplying us with stuff. Countries are going to compete, companies are going to compete, they're going to overorder. That means supply chains will be stressed again. Supply chains just went 12 rounds with Mike Tyson, and now they have a fresh game with Muhammad Ali. This is pretty much the analogy to today. Or Conor McGregor, if you would prefer. Supply chains are going to take more hits, and that's going to put extra pressure going forward. And next slide. So we don't have regulatory help, and we will not have much fiscal help. Why? Because governments are not too keen to spend more money. Why? We saw this also in the last budget. There were a lot of people who assumed that Chancellor Sunak would defer the national insurance tax rise, but he didn't, because it's very, very difficult. He needs to pay for hospitals and schools, and he could either issue more debt and then ask the central bank, who said that it's an independent organization who are rising rates, to shift their policies and print more money to pay for that debt, or he can directly go to markets and get 2.5% for the extra debt, which means raising the cost of debt repayments in the near future. So he couldn't very well do this, especially with less than a month's notice. So the rate hike, the tax hike goes as planned, and this is what's going to look like. We will not have much fiscal policy help, and will not have monetary policy help, and will not have regulatory help in this one. Next slide. Now, having said all that, the initiatives taken as far as markets are concerned, not the economy, but markets, are at the very least keeping prices, equity prices, at a good level. In the last 2 years alone, we printed 11 trillion, more than we printed the 8 to 10 years before, after the global financial crisis. And already the governments have pledged a lot of money for this year. It was just intended to repay the burdens of COVID, not the burdens of Ukraine and the extra inflation. So next slide. What I think is going to happen is that a lot of policymakers are going to go back to the drawing board, and we're going to see different choices maybe in the near future, different policy choices. And at some point, the issue of a hard-pressed consumer, be it British, German, French, American, is going to be discussed and addressed. So at some point I saw a question, what do you do with your portfolios? First of all, we have them. Long-term investment principles apply. This is the beauty of asset allocation. When you make an asset allocation call, when you have an asset allocation, in essence, what you do is you look beyond. In any given year, you can have a bad year. It's impossible to predict beforehand. We try, we obviously make tweaks, but at the end of the day, it's impossible to know what asset prices are going to do beforehand. But what you do when you buy an asset allocation, when you have it, is you look beyond that and you say, okay, the question 3, 4 years, 5 years down the line is, will capitalism hold? Will it find ways to reinvent itself and get through that? And if I learned anything as a veteran, not just of the global financial crisis, pardon, this is a more private comment. I am Greek. So I have lived since 2005 that I started working. I've lived through the global financial crisis, a Greek default, a Cypriot default, because I used to work for a Cypriot bank. I moved over to the UK. I experienced Brexit, and then there is COVID, and then there is there's this super inflation thing. And bar the previous ones, we always had this negative outlook on things, but this is what forces capitalism to reinvent itself. Having an asset allocation means that you're making a bet that capitalism will hold its own. Okay, and that has proven historically a better bet than just holding cash, especially in this environment where cash is expected to lose 3 to 5% of purchasing power. Now, visibility is very low. Yes, that works two ways. Maybe the war in Ukraine ends. Maybe the sanctions are lifted because the Europeans simply cannot uphold them. If you want a more recent example of the exports, British exports post-Brexit have gone to almost pre-Brexit levels. Okay, despite all the bureaucracy, that means supply chains found a way to mend themselves. Okay, this is exactly the sort of bets you're making with a wide and dispersed asset allocation. Also, there is enough liquidity out there to cover even for some of the policy mistakes that we might see from central banks. We say they're tightening, fine, they're from 0%, they'll go to 1%. They will not go back to the 20% interest rates we saw in the 70s, which is what in theory would take them for them to fight inflation. At the end of the day, they're just signaling to markets and to policymakers we're doing something about that. And finally, why we think the long-term investment principles apply, the Fed will have a much bigger tolerance for volatility, that's for sure, because its primary goal now is to deal with inflation. But I don't think it's infinite. I think the Fed put is still in effect. If the markets go down by 30%, the Fed will intervene and it's going to change stats. It's going to print more money, and markets know that. That's why, despite this outlook I just gave you, the S&P 500, the world's most, the foremost equity benchmark in the world, the total of American stocks is at nearly 4,600 points this morning, just shy, 200 points shy of its all-time high. Markets see exactly the same things we're seeing, but they also have good reasons to be invested. And with that, I would like to open it up to questions.
Excellent. Thank you very much, George. I think you just about saved us from the doom and gloom that I opened with. We've got about 5 minutes, so let's try and squeeze in 2 or 3 questions, and thank you for those people who've submitted those. Forgive me, I'm working off one screen here. Let me ask you this, because I know this is a topic that you have some views on, and we've discussed quite a bit in recent times. So the question comes from Nigel. It's over recent decades, the talk has been about the global economy with more free trade across the world. Are these times coming to an end? So do we see an end of, or perhaps a change to deglobalization? Sorry, to globalization rather.
Okay, so David must be ecstatic by this question, Nigel, because he and I have been having those discussions for over a year, and in fact, it's probably going to be the main topic of our upcoming quarterly. I've been working on it for the last 2 months. So the long and short of it is no. And just take Ukraine. And mind you, I was the bear in, I was the most negative about globalization in this discussion. Just take Ukraine, for example. Ukraine happens and then all of the world is instantly affected. Doesn't matter where you live. This is proof that globalization exists. Now, there are going to be bumps. Why are there bumps to globalization? Well, they're very normal, because globalization reached the point where it's threatening the nation state. You know, um, how can Britain exist? How can Greece exist in a globalized environment? You know, you're not making your own stuff. You're not self-sufficient. Therefore, you're dependent on others. But laws are local, and governments are local, and decisions are local, and politics is local. But the world and the economy you live in is globalized. So what we're witnessing is the convulsions of globalization. Now, it's my view, it's probably optimistic that we'll get through those convulsions, and that's probably going to be with some technological achievement. Having said that, and I don't want any misunderstanding here, there is a historical example when progress went back. In the 3rd century BC, we were discovering Rome was paving roads to everywhere, or shortly thereafter. Aristotle was discussing big ideas. Archimedes was finding new technologies that are now lost to us. And 200-300 years later, after Rome descended into autocracy, the world came to a standstill, and then for about 1,000 years we experienced the Dark Ages, okay, where we stopped short of returning back to the trees. So it can go into reverse. But I honestly think that globalization has such a dynamic which is economically driven. And yes, autocrats everywhere don't like it because they try to maintain control. But I don't think they can resist it for too long. It's just that for globalization to be maintained, we're going to have to come up with new institutions that are global in nature and that work. Okay, and that's the challenge for the next generation. It's to stop thinking in terms of the nation state and think in terms of global institutions, not like the UN, but those ones that actually work.
Thank you, George. I mean, certainly we're seeing in conversation with our corporate clients that this is very much something that is on companies' minds, is their reliance on the supply chains as they stand at present. And that's not to suggest that there's going to be, large-scale onshoring. We think that it's more likely to be just a little bit of diversification in terms of where your dependencies lie across your business. So not deglobalization, but perhaps just a variation of what we've seen in the past. And certainly, George, I agree with your point around global institutions, this being an opportunity to reform those and rethink what their purpose is. Let's try and squeeze one other in. We've a couple of questions, one from John, one from Paul, around bonds in the portfolio, George. We've spoken about interest rates rising, and that means the value of bonds falling. Now, if we had one of our investment committee members on this call, he would get very agitated about the whole mark-to-market approach of valuing investment bonds. But it's a fair question, isn't it, as to why you'd want to hold bonds when there is an expectation of interest rates rising?
So, and not just that, there is the inflation to consider. If I hold a bond that gives you 2%, when inflation is at 5 or 6 or 7%, you get an assured loss. The answer is, as Anthony from our investment committee would say, first of all, you hold it to maturity. So inflation is thus today, but might not necessarily be the case for the next 90 years. But the longer answer is going back to asset allocation. On any given year, you don't know how things are going to work. This morning, the US 10-year was at 2.5%. This is now just above inflation expectations over the next 10 years. This means that now you get a positive, if we think that inflation is going to run about 2.5% in the next 10 years, you're getting a positive potential real return. Okay, so that's a reason to hold it. But the broader thing is that this is the point of asset allocation. We have been negative and bearish on bonds for the last 5 or 6 years. Nevertheless, we've always had a large chunk in our portfolios, and it always made sense to diversify. This is why you make a bet on asset allocation rather than specific assets, because when you make a broad bet, it's an easier win. You trust capitalism.
Thank you, George. And I think as well as the points that you make, we have made changes in the portfolio as well as being underweight bonds generally. We've reduced what we would call duration in our portfolios, i.e. the sensitivity to the interest rate rises that we've seen and that we anticipate. So, John's question about, is there a benefit to investing in bond funds as opposed to directly into bonds? We would probably argue, John, that a bond fund manager would make a similar decision to that which we've made within the portfolios, which is to try and reduce the impact of interest rate rises and probably operating shorter dated bonds, where actually, given the shape of the yield curve, which is pretty flat at the moment, you can pick up decent yield without having that exposure to significant duration. We've had an awful lot of questions, George, about inflation. I think we've probably covered most of them, but let's just finish with this, which is, when is Andrew Bailey going to resign for his poor response to inflationary pressures? I'm not sure whether Paul, who's asked that question, thinks he should have done much more quickly, or done nothing because he can't have an impact on the sort of inflation that we're experiencing, or indeed there were some comments that Andrew Bailey made about wage rises which were viewed to be insensitive. I think they were clumsily made, although we probably appreciate what he was trying to get at was, we don't want to exacerbate inflation to make it worse. So I think this just goes to the challenge that central banks face, does it not, George?
Yes, central banks, as we said, they're national institutions and they're faced with globalized inflation. They can't control it. And the main question for them is going to be an existential one. It's not whether Andrew Bailey or not is going to resign, but whether the Bank of England, if it does not have such powers over inflation, then should it remain independent? Because in the past 10 years, central banks have been making a lot of calls, printing money that mainly went to the portfolio holders, which were the top 10 or 20% of income earners, and possibly after some point at the expense of the economy and the rest of the 80%. And they did that because they were independent. So after that track record, and if they not manage to fight off inflation, I think a real challenge is going to come towards their independence. I think central banks, much like any other institution, are going to have to reconfigure themselves for a globalized world, or in their current form, they're going to face challenges. I'm not going to say extinction, but they're going to face challenges.
Excellent. Thank you very much, George. We're a few minutes over time, so we better leave it there. It just remains for me to say thank you very much for choosing to spend your time with us this morning. Our next session will be either on the 24th or the 31st of May, but we'll obviously send the invites out nearer the time. So from George and myself, thank you very much, and have a great day.